Welcome students, Tom Harmer here, your accounting professor. This will be a demonstration of how to use this all-in-one financial planning tool I've created in Excel. My hope is that you will use this tool to help plan your future and achieve your goals. Stephen Covey says in his book called The 7 Habits of Highly Effective People to begin with the end in mind. So this is a tool to help you begin with the end in mind. We've got here our financial planner. It's going to show your annual and monthly cash flow. It'll show you whether or not you qualify for home financing so you can purchase a home. It shows you your wealth accumulation and all your various assets, from your 401k, from your cash capital account to your real estate investments, and then the retirement payouts when you're drawing out of those assets in your years of retirement. So here, this chart over here, currently blank, shows your total income, salary plus 401k draws, capital draws, and reverse mortgage on your home. All of these draws kick in exactly on the day that you retire. So we'll go from salary or wages to it'll disappear, and then boom, we'll be into retirement in this chart. Over here, this is showing all your wealth accumulation. We have a total, and both in the income area we have total income from all sources, and over here in assets we have a total, and then it's broken down 401k, cash working capital, and home equity. Okay, so as you can, then over here on the right side we have our home financing and net cash flow analysis here, annual and monthly. So this takes us from your salary and other items we'll go through later on, but essentially it's got your credit card payments, your auto loan payments, your water, sewer, garbage, heating, electricity, all your utilities, any savings that you're doing, which of course we're budgeting for in this plan, and shows you your net cash flow, annual and monthly, and that tells you what you can afford to save per year. Then we put that in, and then of course whatever we're saving is going to reduce our net cash flow for funds for living. Living being having fun and enjoying life and those sorts of things. So we need to always have a net positive cash flow. So let's go ahead and get started here, and I'm going to demonstrate walking through this and how to use the program. So we'll demonstrate it. My assumptions I have down here, right in this area right here, I have assumptions. Your age, in this demonstration it's the age of 25 as of the year you graduate from college, and we're assuming you get a job in the year you graduate. There's some reasons for that we'll talk about later. Then your retirement is your age from the beginning at this demonstration, 25 plus 25 years. So we're saying 25 years to retirement. Okay, so you'd be 50 in this example when you retire. And we also have 40 years from the date of retirement to death. And yes, unfortunately, we are all going to depart this world. Okay, at retirement, all investment payouts begin at retirement. And the number 1 in the charts, and the numbers are really, really small up here, as you can see, the age of 25 will be the first year. Let's come back here. So we're going to start off, let's get our basics in here. Okay, I'm 25 years old, and we're saying our first job here is $50,000 per year. It's my salary. It starts at $50,000 right there, and this is the 2% inflation. So my salary, this is assuming we didn't change jobs, we didn't get any pay raises except for the inflation rate. Okay, and then at retirement here, you see if I can get right over that, that says 0.23, get right on this 24, we're right in there at 25. Okay, and then it disappears because we have retired, we have quit working. So this is the only thing in the picture. We got no assets, nothing at this point, because we've only entered our income. Okay, we're assuming a 6.25% rate of return on any investments anywhere. Okay, now let's see, we got a 401k savings balance, we got that at 0. we got a 401k annual savings amount. Now, if you have, if your job includes employer matching of contributions to your 401k, then you absolutely need to, go for your max. Typically, the employers will match 10%. So you withhold 10% from your pay, so that would be $5,000 a year in this example, and then they'd match that. But we're not going to put anything in there, because if you don't have employer matching, you want to get all your cash into savings down here, because you need cash liquidity in order to qualify to buy that home. As we move on here, you'll see in the rent versus owning comparison the enormous impact of owning versus being a renter. So we'll get to that later. Let's just take a look over here at our cash flow picture. Okay, annual, $50,000 a year. Okay, and then we're at less Social Security and Medicare. That's the employer's paying the other half. That's what they take out of your check. And I'm estimating about a 15% withholding from your check for income tax. Okay, and at this point we haven't budgeted anything else. That shows a net cash flow of $38,700 a year, or a net cash flow of $3,225 per month. Okay, well, let's finish entering in all the realities of life over here, and then see what it comes down to. Okay, we've got, let's say we're paying rent at $1,270 a month. Okay, oops, it's got to be entered as a negative number, minus 1270. Boom, there's our rent. Monthly health insurance. Now, if you're employed and you have a copay and you're only 25, that's going to be down there at maybe around 50 bucks. That's a minus 50. Now, let's say that we have no car loan. We're just driving a nice inexpensive car we paid cash for, and we got zero out there on our credit cards. Okay, but we are paying monthly electricity, water, sewer, garbage. And by the way, we're assuming that we're renting a little house, not an apartment complex where the complex is paying for the water, sewer, and garbage. Okay, so we're looking at this like a little house rental. Okay, so I've got that in there. Monthly, let's say it's a small little house, we're looking at minus 100. Okay, with heat and all of that, average for the year, minus 125 per month. Okay, for all utilities. Okay, so we've got no car loan. Now let's come up here. So we've got health insurance is $600 a year, or $50 a month. Our rent is $1,270 per month. Our utilities are $125 a month. So now you notice here our net cash flow, we've got no auto payment, we've got no credit card payments, we don't have any savings budgeted, we just have utilities and our rent for our housing and our withholding from our paycheck. We've got $21,360 available there that we can invest for the future. So let's say that we do that. We come over here and we are going to take 10,000. Let's take 10,000 out of that per year. Okay, and that right there jumps our assets up immediately. See, and that's our cash working capital jumped way up here to the point of retirement. And look at that, when we retire, we are at, it is paying out now, it is paying out almost $40,000 a year at 7% of the balance of that capital account. So that's retirement income. This is at 50 years old, so there's no Social Security or anything like that coming in. But that's just that one investment. Of course, we're going to use a chunk of that cash in order to buy real estate. But let's take a look here at our rent picture. Okay, we're renting, right? We start off right here, and this is $1,270 a month. The rental appreciation or inflation rate is twice the rate of inflation. Okay, so like if inflation is 2%, the rate of inflation on rent is 4%, and in fact it's even more than that. Every time there's a turnover, landlords will go for the highest rent. Okay, so like they always do, the biggest increases on rental turnovers, and those rates are actually, I could put in 5% there very easily, but we're just going 4%. So that's where your rent's going. Okay, now our next step here, let's see, we've got utilities in there, we have our savings plan in there, all going to cash at this point. And so let's take a comparison of what happens when we purchase a home. Okay, now we're going to go here at 25 years. I've got my total assets at 25 years is, okay, we're a renter, 569,787. Okay, total assets, 569,787. Okay, retirement income. So when we retire, we started off at about, we'll just round that even to 40,000 per year. Okay, retirement. The cost of housing at that time, let's come over here. So here we are on the, we're looking for the year 25, which is when we retired. It's going to be at 50 years old, 26. Okay, there's year 25. My rent now is $32.55 per month. Okay, so that's $32.55. So there we are, that's when we're renting. Okay, now let's go to home ownership. The first thing I'm going to do here is I'm going to just put the home loan in here. Let's see what we qualify. Let's go in. I want the same monthly payment here as we had for rent. So I know that was 200. Okay, 200,000. That brings me to principal and interest plus taxes and insurance equals $1,270 a month. Okay, so we come to our graph and you see here we are at the starting point. We're both at $1,270. Look at that rent go up. Ooh, ugly, ugly. Now, but you know what? This is a 30-year fixed mortgage. Fixed. Hear that? Fixed. So that, you see that mortgage, it's barely going up. It's going up because the real estate taxes are increasing with inflation. But look at this. Boom, it drops down. Why? Because it's a 30-year mortgage. At the end of the 30 year, it's paid off. So it drops down to just paying the real estate tax now. Now you look at this area in between. What do you call this area? You'd call this area the cost of making the mistake of being a renter rather than an owner. Okay? 2, you could also call this the wealth accumulation of your landlord. Okay? Or the lost opportunity of wealth accumulation you have if you decided to. Okay? So that's what that area there is. Now I'm going to come over. I'm going to get rid of the rent here. Boom. It's gone. And so here we are. We've got about $1,000 a month spare change for other things. I guess you'd have to say that we don't have any kids, so we don't have other overheads that make it difficult to save $10,000 a year. And let's come back and take a look at our income chart over here. Okay, so we have now total retirement income as when we own property. Now we are at $91,000 per year retirement income. Okay, and that's because we're getting a reverse mortgage on this home mortgage. Now I see this home equity is this guy here. Home equity is growing here. And we have that. Okay, there's home equity has built up to 514,000 at retirement, and then it starts going down. But you notice it starts swinging up here because we paid off that mortgage, and so now we're swinging back up to, we're not pulling out as much as we're appreciating in value. Okay, so, and then over here, this is our working capital cash account. Could be the 401k, because you could after you get your property, you can be putting money into that 401k, which can happen like a year or two after you get a job. Okay, so that's our situation here. Let's take a look at our total assets with home ownership. Okay, that is $1,082,000. $1,082,000 in total equity and investments in one house versus $569,000 if you were a renter. Okay, and that was that area we talked about. Okay, so you're capturing that. So what is my housing cost here out there at, let's see, we're looking for year 25, 24, 25. My housing cost is $1,468. So take a look at that picture. This is owning, this is renting. Which one would you like to be at? Okay. another item I didn't mention in this monthly housing payment. When you own, you're paying off that mortgage with inflated dollars. And I didn't put that in the graph. If I did that, your payment would be offsetting, be going down. You've got the inflation rate going up on your real estate tax, but then you've got your inflation value of your dollar causing your dollar to be more and more worthless. If you threw that in there, your payment would actually be going down. Okay, and then of course over here you can see at the 30th year you've paid off the mortgage, so it drops down to real estate tax only. Okay, so there you go. There's my argument for owning, and that's just one house. Okay, there's other things that we talk about in some other segments of financial planning study. Well, let's take a look at some other ways you can use this all-in-one financial planner. Let's take a look at what the most we can afford with our income. Okay, we've got no other debt going on here right now, so let's just take it. We're in pretty good shape. Let's go up to $250,000. Let's see if we can afford that. It says congratulations, we do qualify both on front and back ratios. 260. Okay, we're still good. Go to 270. Okay, now here we don't qualify now for this mortgage because, see, the lenders will take your monthly gross income, your salary there with no deductions taken out of it. They divide that into your total housing payment. Okay, in this case our housing payment is, let's see, this is $1,714 would be your principal, interest, taxes, and insurance payment on a $270,000 30-year mortgage. Okay, they divide 1714 by 4167 and they come up with 41%. Well, the most they will go is 40%. So we need to reduce this mortgage. Okay, let's go to 265. Now, I got to go down again, 260. So you see how you can use this tool? I qualify now. So there you go. And by the way, when you graduate from college, the lenders do not require a 2-year seasoning on your income like they would do normally. They will, you get that, say the first month you get that job, you get your employment contract, you got your first paycheck, you go to the home mortgage bank, and because you've just graduated from college and got a job in your same line of study, then they will waive the 2-year seasoning and you will qualify on this home mortgage immediately after the first month of being on the job. Okay, now I also have right here cash reserves you got to have in your savings checking account also to qualify, because you can't qualify for a home mortgage if you're flat broke cash wise. Okay, all the equity in the world won't matter anywhere else. It's got to be liquid funds. Can't be stocks, securities, that sort of thing. Okay, they want to see 3 times principal, interest, taxes, and insurance in reserve to close. Okay, so now let's take a look at the impact of if we had a car. Okay, so now we're at a $371,000 value house with a $260,000 mortgage. We come over here and let's put in an auto payment of $200 a month. Okay, and remember this is all going to be entered negative, minus 200. Okay, that means $2,400 a year is being paid out. Let's come over here and we still qualify. Okay, we're only at 44%, but let's say that we had $5,000 of credit card balance out there, minus $5,000. Now they see credit cards, the lenders will take 10% of your credit card balances and use that as the monthly payment for the credit cards, regardless of what your minimum payment is. So that's $50 a month or $600 a year. So we've still got $316 a month available for playing around and food. So I guess that covers food. So there you go. You know, you're not playing around much at this point. Okay. But the point here is showing you what an auto loan can reduce your borrowing capacity. So we don't qualify. So let's go down to 250. thousand. Okay, that brought us back. So we lost $10,000 of loan borrowing capacity, and our home value went down about $10,000 or so too. So anyway, that's a little demonstration of how you can use this financial planning tool for seeing what you can afford to buy. Now, in another segment of this series of seminars is how to buy houses wholesale for 70% of fair market value, 100% financed at closing, and then refinance them into a 30-year fixed at this appraised value, so you've got no mortgage insurance, and you've purchased this house 100% financed. You've purchased this house, you've automatically got $107,000 of equity when you purchase this house. That's another seminar we'll get to. Okay, well, that's a pretty good review of this all-in-one financial planner for you, and I am hoping that you will use it as a tool to plan your future. Now, I'll just show you a couple of other things. Once you've got your basic data in there, you can come back and change my assumptions. I said the home appreciation rate was 3%. Let's say that was 5%. So I'm coming over here. I enter 5 and watch what happens to the graph. Boom. Look at that. Right? My income thing, the total, we went up to now $2,893,000 value, when at 3% it was $1,082,000. That's just by changing the appreciation rate on real estate in the Great Northwest in particular. It's a hot zone. Okay, so we'll go back to 3% there. Now let's say that if I change my withdrawal rate, okay, in my cash working capital account, which you could consider also the 401k. I've kept it simple and not used two savings accounts here. 401k, of course, is tax deferred, and if you have employer matching, it's a great way to go. But having the real estate is more important than having a 401k when you're 25 years old coming out of college. You want to get the real estate. Okay, so you can come down and change these percentages just to see the differences that it inflicts on your assets and retirement income. So with that, this is my tool for you. And with this, you can learn personal financial planning and get some big answers to areas of uncertainty. And okay, so I have another video, a much shorter one after this, which is on the 5-year retirement plan. And it involves investing in not just one house for your whole life, but purchasing a house, moving into it, fixing it up, selling it, and doing it once a year until you have accumulated the retirement that you want. And I'll show you the process of buying the houses wholesale and 100% financing, and then the process of accumulating enough wealth to retire in 5 years. Alright, well, I hope you watch that video too. Nice being with you, nice sharing with you. Best wishes for a successful future. Thank you.